Imagine you're applying for a loan, right? And you get rejected. But not because of your credit score, but because you're a woman.
It's definitely a bit of a head scratcher.
Yeah, it does seem kind of unfair. And that's actually what we're going to be looking into today. Kind of this weird situation where laws designed to stop discrimination might actually be making it worse when it comes to AI and giving out loans.
It is. And as AI plays a bigger and bigger role in finance, this is something we really have to pay attention to.
Absolutely. So the jumping off point for our deep dive today is this research paper. It's called, get this, Anti-Discrimination Laws, Artificial Intelligence, and Gender Bias, a case study in non-mortgage fintech lending.
Quite a mouthful.
I know, right? But we're going to break it down and make sense of it. And just so you know, this isn't just some random opinion piece. This is serious research. It's peer-reviewed and published by Informs, which is a big deal in the world of data and analytics.
A very well-respected organization. And in this paper, the researchers really dug deep. They wanted to see how the laws in different countries about using gender in lending actually affect who gets loans and whether AI is really better than traditional methods when it comes to being fair.
Right. So let's kind of set the stage here, lay some groundwork. The research talks about 3 basic ways that countries approach the whole issue of using gender in lending. So first up, you've got places like Singapore. They're okay with collecting gender data and then actually using it in their AI models for loans. We'll call that regime 1.
Regime 1. Got it.
Then there's the European Union. That's regime 2. They collect the data, but they say, nope, can't use it to actually decide who gets a loan.
Interesting.
And finally, you've got the U.S., which is regime 3. They're like, no way, not collecting it, not using it. Gender is off limits.
3 different approaches. 3 different regimes.
Exactly. Now, this is where it gets really interesting. The research actually found that in some cases, those laws that say you can't use gender in loan decisions, that's like the EU and the US, those can actually end up making discrimination against women even worse.
Which seems kind of backwards, right? You'd think a law designed to protect people would, protect them. But sometimes there can be unintended consequences.
Totally. And to really get to the bottom of this, the researchers used real-world data from this company called Home Credit. They're a global lender. And they tested out both the traditional statistical models and all the fancy machine learning algorithms.
And the results were consistent, regardless of which model they used.
So in a way, these models are trying to be blind to gender. But in doing that, they might actually be perpetuating bias without even realizing it.
Right. It's almost like if you're baking a cake, but you leave out a key ingredient, it's not going to turn out how you expect.
Perfect analogy. But AI is supposed to be so smart, all sophisticated. Why is it making the same mistake?
Well, that's where things get even more fascinating. See, machine learning, it's powerful, but it also has its own kind of quirks. And one that really comes into play here is something called, get ready for this, gender-blind feature selection.
Gender blind. What was it again?
Feature selection.
Feature selection. Okay, I'm intrigued. Break that down for me.
Okay, so imagine that machine learning is like a super detective, right? It can look at tons of data, tons of clues, and even come up with new clues based on what it sees. That's called feature engineering.
Pretty cool.
Then it picks the most important clues to solve the case. That's feature selection. The problem is, if we tell our AI detective, no, you can't look at gender, it might end up picking clues that aren't very helpful in figuring out a woman's creditworthiness.
So it's like trying to figure out someone's favorite book, but you don't know anything about their age or what kind of stories they like. You're bound to make some pretty bad guesses.
Exactly. And those bad guesses, that's what can lead to even more bias, even though the whole idea was to be fair in the first place.
Okay, so we just heard how those laws that try to promote fairness by saying, don't even ask about gender, might actually be backfiring and making things tougher for women when they're trying to get loans.
It's a real paradox.
It really is. But let's dive into the specifics. Like, what did the researchers actually find when they tested out different ways to fight this bias? They looked at 4 main approaches: downsampling, gender-aware hyperparameter tuning, upsampling, and that mouthful probabilistic gender proxy modeling.
Right. They really wanted to put these methods to the test, see how they performed with real-world data and what the trade-offs might be.
Okay, so starting with downsampling. That's where you basically try to even things out by reducing the data from the overrepresented gender.
Which in most cases would be men.
Right, exactly. So did that actually work? Did it lead to fairer loans?
It did, to a certain degree. The research showed that downsampling did lead to less discrimination, but, and there's always a but, the model wasn't quite as good at predicting who would repay their loan.
Ah, so there's a trade-off there. You get more fairness, but you might lose a bit of accuracy.
And it also had a small negative impact on the lender's profitability.
Right, so it's not a perfect solution. Okay, what about that other method, the gender-aware hyperparameter tuning? That one seemed pretty clever.
Yeah, that one was a standout in terms of reducing bias. The results were actually quite impressive.
So it works well.
It does, but again, there's a trade-off. While it was great at reducing discrimination, it did cause a slightly bigger decrease in the model's accuracy compared to downsampling.
Hmm. And how did it affect the lender's profits?
It had a small negative impact on profitability as well, slightly more so than downsampling.
Okay, interesting. So it seems like there's always this kind of balancing act, right?
Exactly. Fairness, accuracy, profitability, they're all part of the equation.
Right. Okay, let's move on to upsampling. That's where you try to get more data from the underrepresented gender.
Usually women, in this case.
Yep. So did that approach have any positive results?
Upsampling actually had some really great results. Not only did it significantly decrease discrimination, but it also didn't negatively impact the model's ability to accurately predict loan repayment.
Oh, wow. So that sounds like a win-win. You get more fairness and you don't sacrifice accuracy. What's the catch?
Well, the catch is that it did lead to a small decrease in the lender's average profitability.
Okay, so not a perfect solution, but still pretty impressive. All right, let's talk about the elephant in the room. Probabilistic gender proxy modeling. What a mouthful.
I know, right? But it's a fascinating approach. It's basically trying to work around those rules that say you can't collect gender data. So instead of directly asking about gender, the model tries to figure it out based on other information, kind of like a detective using clues to solve a mystery.
Right. So how did that method perform? Did it work?
It did, and it did it incredibly well. This method dramatically reduced discrimination, had no negative impact on the model's accuracy, and even led to a small increase in profitability for the lender.
Wow, a triple win.
It does seem that way. But of course, we did talk earlier about how this approach might not be legal everywhere. In some countries, like the US, it would be a no-go.
Exactly. So even though it works well, it's still a bit controversial. Okay, we've thrown around a lot of technical terms here. Let's bring it back down to earth. What does all this mean for the average person who's just trying to get a loan? What should they be aware of?
That's the key question, right? I think the biggest takeaway here is that AI is becoming more and more common in loan decisions, which isn't necessarily a bad thing, but it's important to remember that AI isn't perfect. It can still be influenced by the biases that exist in our world.
So how do we protect ourselves in this new world of AI-powered loans?
Well, that's tough to say. There's no easy answer because it really depends on the lender and what's happening behind the scenes with their algorithms. But knowledge is power, as they say.
Right. So do your research.
Exactly. Understand your rights, don't be afraid to ask questions, and demand transparency. You have the right to know how those loan decisions are being made.
So for those of us who want to see a fairer financial system, especially for women, what are the key takeaways from this research? What should we be pushing for?
I think the biggest takeaway is that just banning the collection or use of certain types of data isn't always the answer. Sometimes it might actually do more harm than good. We need to move beyond those simplistic solutions and really grapple with the complexities of AI and how it interacts with fairness.
So we need to look deeper, think harder about how to build AI systems that are truly fair for everyone.
Absolutely. And that means having those difficult conversations, doing more research, and putting in place strong regulations that will encourage responsible AI development. Because at the end of the day, this isn't just about numbers and algorithms, it's about people's lives.
Well said. This deep dive has been a real eye-opener. I think we've given our listeners a lot to think about.
I hope so. Hopefully this knowledge will empower them to speak up and advocate for a financial system that's fairer and more inclusive for everyone.
Yes, absolutely.